Right now, we are joined by Cathie Wood, ARK Invest CEO and CIO, who's going to be speaking here a little bit later. It's great to see you this morning.
Great to see you, Andrew.
There's about 100 things to talk about, including Bitcoin and the distinction between what's happening with Bitcoin right now and gold and the like. But I do want to start on Tesla.
Sure.
Because we've seen the price action in Tesla, which has fallen on the back of worse than expected numbers. And I'm just so curious what you think is happening at Tesla right now, and whether, and there are some analysts out there that now have gotten bearish or starting to believe that we are at some kind of big inflection point.
Right. So I think a couple of things are going on. First, and Elon's been talking about this in the quarterly calls, the consumer is under pressure. There is, even though these economic statistics are coming out and saying everything's just fine, you listen to these company reports one by one, most of them do not sound like these economic statistics are suggesting. And I think Tesla's been telegraphing the high rates. They've been cutting prices to offset them. And they will continue to cut prices. So I think there's economic weakness. There has been a bit of a backlash, I would say, and a pause, because you do have GM and Ford saying, wait a minute, we're going to take a pause here ourselves because we can't do this profitably. By the way, that's a positive for Tesla, you know, to have the competition doing this. And Tesla's just going full steam ahead. So I do think part of it's economic. And you can use all these other excuses. But if that is the case, what's going to happen, we believe, during the next 5 years, and you know that's our investment time horizon, we think the cost of an electric vehicle, the average electric vehicle, is going to be cut in half. And Tesla's new block manufacturing techniques and technology, along with AI, are a big part of this.
How much, and you've been buying on this weakness,
well,
if you want to call it that.
So as we were selling when it was around 400 and 350, when it's been cut in half, down 60%, is not the time to run for the hills. If you believe Tesla is going to be, in this we also believe, the autonomous taxi network, certainly of the United States.
Right now, people are starting to think about Tesla again as a car company. I mean, I think that's what part of what's happened here in terms of the valuation cut has been people said at one point, oh, this is a tech company, right? This is an AI company. This is all sorts of things. And then there were always these bears saying, well, actually, guys, it's not that at all. It's a car company. Now some people are saying, well, maybe it's a car company. What is it? And for the valuation to sustain itself and actually to move higher, does it have to be what you just talked about, a robo-taxi company, a AI company, and all of the above?
It epitomizes the convergence among technologies that we are seeing today. And the robo-taxi network is not an if, it's a when. It's already happening. Waymo is out there, you know, proof of concept. So it is going to happen. And if you've tried version 12.3, FSD, you'll see that Tesla...
This is the full self-driving mode that we should say is not fully self-driving just yet.
Correct. But if you drive, if using it, you will find that it is becoming more precise, but also a little more aggressive, like a human being would be, instead of this, you know, more cautious. So I think we're getting there, yes. But it epitomizes three technologies: robotics. These cars are and will be robots. And, of course, he's got the whole humanoid robot going as well. Energy storage. Autos in the future will be electric. We believe in 5 years, 75% to 85% of all sales will be electric. Here in the United States and around the world.
Even with the pullback that we've had in terms of EVs and the adoption.
Think about this. Yes, because if we're right on what's going to happen to auto prices, the average EV will be in the $20,000 to $25,000 range. The average gas-powered car will be about where it is right now, or a little more.
When you have the GMs and the Fords and everybody else saying we can't even make these things profitably to begin with, let alone to do it at half the price.
And just think about this. Tesla's doing it profitably and cutting prices in the process. It's pretty phenomenal. Can I just go the convergence idea? Yeah. One more. Robots, energy storage, they will be electric, 75, 85% in 5 years. And then artificial intelligence. This is the biggest AI project in the world. If NVIDIA is worth what it's worth, and we believe it's worth what the market's paying for. We think it's going to have an inventory correction out there. It happens regularly. Okay. You know, we've been through very many inventory cycles. Right. I have over the years with NVIDIA. So definitely going to see an inventory cycle as companies reassess, okay, wait, how do we get ready for this AI age? And there is a reassessment process. We're going through it ourselves. But if NVIDIA is, if its valuation is correct, this AI project has to work.
What is Tesla worth? If you were willing to sell it at $300 or $400 and you're buying it now, what is it worth in 5 years?
$2,000. We're in print on that.
$2,000.
Yes.
Let me ask you another.
And think about that. It's down 60%. This reminds me very much of 2018-19. We're in a bit of a trading range, and we will be until more and more analysts, investors understand how provocative the convergence of these three technologies is going to be.
Let me ask you this. When you think about the Magnificent Seven, a lot of people have taken Magnificent Seven and now called it the Fabulous Four or the something else, but Tesla's not in it anymore.
Right.
Is that the right way to think about it? What does your Magnificent Seven look like today? I always think about your fund as a lot of the Magnificent Seven.
Not really. We have actually, if you look at the overlap of our fund with the NASDAQ or the S&P 500, very little overlap, maybe 5%. Tesla, Meta Platforms. We think AI could be quite disruptive. There are other disruptive forces taking place that could dislodge some of the Mag 6. I mean, the GPT-4, for example. I don't have to go through Google anymore. I can just say, take me to a place where I can buy these shoes at the cheapest price for delivery, free delivery, in 2 days. You know, that's disintermediation. That's technology at work.
Tesla shares dropping yesterday, now down more than 30% for the year. That comes after a drop in first quarter deliveries disappointed the street. It is the first decline since the year 2020. Joining us right now to talk about Tesla and the broader markets is Sylvia Jablonski, Defiance ETF's CEO. And Sylvia, what do you think? That drop in the first quarter came as a surprise because it's the first time we've seen that since 2020.
Yeah, and I think that this is the first time where they have a whole lot of headwinds facing them. So I think that, you know, EV demand has just shrunk. There are fewer people interested in buying these cars, particularly with rates as high as they are. Mm-hmm. And then the company itself has had issues. You know, they had a fire, they have lawsuits, they've had, you know, a stain to their brand, I think, at this point. And just in general, just the popularity of EVs has slowed down in the near term. I don't think that this is necessarily bad for the longer term, but for the next 6 to 9 months, you know, as a Tesla shareholder, you might not be super thrilled with where the price is going to go.
Part of the concern also has been competition coming in from China, yes. BYD. Is that a threat in this market? I mean, it's a threat they're going to face in China, but is it one that you think they eventually face here or not?
I don't think it's a threat that they're going to face here for a long time, but China matters a whole lot to Tesla. You know, it's the world's second largest economy. Tesla has had a strong foothold there, and I think that they're going to lose some of their presence there because of BYD. But I think, you know, if we kind of take a step back in terms of Tesla, where the future might be bright for them might be in the AI world, you know, the self-driving vehicles, the robo-taxis. If they ever kind of accomplish that, they could potentially generate some revenue streams. And also, Tesla has cash, so they've been able to cut the prices of their cars. They've been able to better their margins, improve their supply chains and things like this. So I think that, you know, if you kind of stick it out for the long term and you believe that electric vehicles can grow a little bit more, Tesla will probably remain a winner in this space.
It's kind of interesting because that's a theme I'm thinking of for the entire market. Does AI overwhelm or can it outshine some of the concerns people have just about if the Fed's not going to cut rates?
Yeah, I mean, I think there are going to be AI winners and losers. Companies like Microsoft and Amazon and Google that do a whole lot of other things that are also going to participate in AI will continue to benefit from that, whether or not there's kind of churn in that theme. But companies like Apple and Tesla that are a little more consumer-driven may suffer in the near term on that. But, you know, I do think that AI is largely, you know, the largest tech innovation opportunity that we have as investors for the next 5 to 10 years, without a doubt.
We are talking about concerns in the market, the potential for a pullback, but we're still only about 1.5% from record highs.
Yeah, I think that the panic is a little bit overdone as usual. And I think investors are sometimes their own worst enemies. You know, the market falls back a little bit and it's like sell, sell, sell. It starts, you know, driving up and we're buying too high. I just think that, you know, these are the times where it takes discipline. I think it's totally fine, again, for the markets to churn. The economy is strong. The data that's coming out tells us that, you know, we are in the soft landing. What will disrupt it? It's hard to see in the near term. So it's sort of like stay the course and buy on the pullbacks. We have kept saying that for the last year.
Would you even consider this a pullback? I mean, 1.5%.
You know what? Not really. But if I have FOMO on a couple of stocks like AMD and Nvidia, not major pullbacks, but you know, I like to get in at lower prices, and you know, I've seen that 900 plus. Right. You got to buy something, right?
We used to say at least a pullback of 5 to 10%. We're not talking about that.
We're not talking about that, but I do think that, you know, again, like there are so many. There's so much opportunity and so much big themes in AI right now that everybody kind of wants to buy those stocks. So if you look at the ETFs that track those themes, if you look at the single stocks and you buy a couple percentage points back, it's, you know, kind of better than buying at the all-time highs. I just think that dollar cost averaging is the way to go, particularly in some of these themes. To your point, it's not a big pullback. I think we can pull back a little bit more. The market kind of ran up pretty quickly since November. Rates are higher than ever. Oil is spiking a little bit. We have to ride this out.
Areas outside of AI that you're watching at this point?
Yeah, so I'm pretty tech happy, let's call it. So I think the next AI for me is quantum computing. So I'm starting to look at those stocks, you know, whether it's stocks like Rigetti or Form Factor, IonQ, even companies like IBM and Amazon that are just investing in that space there. You're starting to see some growth. You're starting to see some investment, whether it's from the U.S. government or China. You know, I think that that's going to be kind of the next ChatGPT moment is going to come around quantum computing. I also like healthcare. These weight loss drugs are obviously taking off, and we have that larger than ever baby booming population that's aging and going to consume services. A lot of these companies like Lilly and Novo have other drugs, so I'm in that too.
Do you worry that any of those stocks are at risk? I mean, they've had huge demand for the weight loss drugs, but there's also a pretty big political push to bring the prices down for those drugs. You hear it from areas in the Senate. Bernie Sanders, I think, just calling for that in the last week or so. You've also got Medicare and Medicaid saying we may not pay for some of these things, or the government may say we want to renegotiate based on what we've already passed. With the laws to renegotiate some of these prices.
Yeah, I think that's a fair point. And a lot of these stocks have been sleepers for a couple of years, but I think that they have enough demand in the weight loss drugs that even if they have to cut costs, they're going to generate enormous amounts of revenue from this, provided that nobody gets sick and we don't find out that there's, you know, serious side effects.
That it's the next fen-phen.
Yeah, right, exactly. But on the other hand, they also have a lot of growth in cancer drugs and metabolic disease drugs, diabetes, things like this. So I just think the overall, and AI feeds into that too, right? AI is starting to help these companies discover more precise and effective drugs. So I do think that there's some runway there.
Those breaking headlines from Fed Chair Powell. He is speaking at Stanford University, and what is he saying, Steve?
He says if the economy evolves as expected, it will be appropriate to lower rates at some point this year. But the Fed chair, speaking at the Stanford Graduate School of Business, says it will not be appropriate to lower the policy rate without greater confidence inflation is coming down. He cites the Fed policy statement in making that comment. He said the Fed has time to let incoming data guide its decisions. And the policy rate, though, is likely at its peak. That's the good news. Inflation, he says, has come down significantly, but it is still running above the Fed's 2% target. The job of sustainably returning it to target, quote, is not yet done. Then he talks about the recent economic reports on jobs and inflation. They have come in, he says, higher than had been expected, but they do not, quote, materially change the overall picture. So what he's looking for is he sees solid growth in the economy, labor markets rebalancing, getting a little less tight in the labor market, and inflation will be moving, as his forecast, towards that 2% target. But he cautions it is too soon to say whether the recent inflation readings represent more than just a bump on the road toward that 2% target. He has a section there where he talks about risks on both sides of the equation, both the risk of reducing rates too early and reducing them too late. But monetary policy is, quote, well positioned, he says, to confront both risks. The Fed decisions. He has a section in here where he seems to be addressing concern about political bias in Fed decision making. He says all of their decisions and analysis are, quote, free from any personal or political bias. And he goes on to say the Fed needs to avoid mission creep, and specifically in relation to its role in the climate change debate. So I'll leave it there, Scott, and basically say I think that Powell is very much repeating where he's been, although maybe just leaving a little bit more room for the recent inflation reports not to have been a bump here. But he still seems to be on track with this idea, sees inflation coming down, and it will be at some point appropriate to cut interest rates.
I feel as though now, Steve, there appears to be a real simpatico, if you will, between Chair Powell and the other members of the Fed, in that they're almost saying the same thing in unison now. We're not there yet. We expect to be there. We're going to cut. We're just probably not going to do it on the schedule we originally thought or the markets first thought. And we're just all going to get our arms around that idea.
Yeah, I mean, I actually tend to think there are a few interesting differences on the committee right now. And those differences concern how you digest the recent inflation reports. I think some saw them as more of a serious setback than others did. I think Powell is more or less in the camp of seeing it as a bump and believes inflation progress will continue, although perhaps slower. I think others see it more as a cautionary note that says, you know what, maybe I need to back off a little bit, or back sometimes way off where I thought I would be. Bostic this morning, you know, he says don't start thinking about a rate cut till maybe Halloween or Thanksgiving or even Christmas. He's in the fourth quarter on a rate cut.
Yeah, interesting. I guess we'll see in the commentary that's ahead, because we do have some time now between, you know, now and when the next meeting is. Steve, thank you. Steve Leisman, our senior economics reporter. Market not doing all that much. You saw maybe a move higher initially in yields. They've probably come down a little bit. There's the NASDAQ for you. We're still at 1/3 of 1%. Weiss, I'll send it back to you. Didn't mean to cut you off earlier. So, you know, Powell's not really telling us anything we don't know, I don't think.
No, I think that's typically the case between meetings, that he keeps the party line going. But you're right. It seems like that the FOMC is coalescing around, you know, we're still ready to ease. We just need to see some more traction on lowering inflation, and the economy remains strong.
BofA Securities head of U.S. equity strategy, Savita Subramanian's here. S&P target of 5,400. It's great to have you, Savita. Welcome back.
To be here. Thanks, Carl.
Your notes have been like an endorphin drip last couple of months, because you've talked about broadening.
Yes.
No euphoria yet.
Right.
Does the gut check this week change any of that?
No, I still think that we're on track for gains throughout the end of the year. I mean, obviously, we're just a few percentage points away from our year-end target, which we just recently raised. But I think the net message of all of the data and the signals and the analysts and everything that we look at and listen to is up rather than down for the S&P. And the idea here is, I mean, when I look at positioning, I don't see euphoria. I see kind of cautious optimism, maybe on a few themes like AI or, you know, GLP-1s, or, you know, now it's shifted to power. But I don't necessarily see this broad-based bullishness on the market. In fact, if you look at the average mutual fund, the average active manager, their beta relative to the market is the lowest we've seen since 2008. If everyone was looking for a bull market, they would be long high beta stocks, and they're not. So I think we're still in that kind of wall of worry phase. You know, I would still say the direction's up from here. You recently went to 250 on earnings for this year. We did. And next year we're looking for like about a 10% incline on earnings next year. And the idea is we're tracking solid earnings growth. We've had margins remain surprisingly flat, not down as everybody was expecting. And I think that means that operating leverage you could get from a demand recovery is going to be that much healthier. So we increased our earnings forecast primarily on just the health of corporate margins. And I think it's kind of nice to see that corporate America has been able to navigate 9% inflation, then, you know, 4%. I mean, this has been a wild roller coaster of CPI prints, but margins have been shockingly stable.
We heard from Stevie Cohen just a moment ago, but something else that he shared was his idea that, in fact, the productivity improvements, and I think I'm getting this right here, I don't want to put words in his mouth, from AI have not been fully appreciated by the market. I'm curious as to how they figure into your earnings estimates and or your overall theme.
Yeah, I think that we're at a point where, you know, we're seeing companies do the right thing. They're spending on automation. They're spending on efficiency, which is what they typically do when you start to see signs of labor inflation. So a couple of years ago, right after COVID, you started to see these automation companies like, you know, industrials, now AI, really reap that CapEx. They were the CapEx takers. I think at some point you're going to want to stop owning the CapEx takers, like the chip companies, and you want to own the companies that are buying the stuff to do things better. And where we are in that trajectory, we might be early in some industries and later in others, but we've already seen a marked shift in the job market and skill sets. I mean, think about Python programming. That used to be like the #1 thing that everybody looked for on a tech person's resume. Now you don't need a Python programmer because, you know, you have AI to program for you. So I think these things are happening real time. In certain industries, it's going to be slower. In other industries, it's already happened.
Are you not afraid, Savita, of rising Treasury yields and a stronger dollar, which is really starting to manifest itself?
Yeah, no, I am. I think that's the risk, is that where I see upside risk in rates is really on the long end. The short end, I think 5% is manageable. Even if we had no cuts this year, I think it'll be okay for the S&P. But on the long end, I mean, if you think about it, the sources of demand for treasuries are gone. I mean, it used to be like, who was buying treasuries? The Fed, China, Japan. None of them are buying anymore. So I think that just that demand vacuum is part of the problem. But there's also the growth angle, which I think is, you know, maybe underappreciated. And the reason that the long end could move higher is because of better nominal growth expectations, better long-term growth expectations. And I think that's starting to percolate with your average investor. The idea of a positive growth surprise, which wasn't on the table last year, is now becoming part of the conversation.
You declared the market's, quote, fundamentally broken. That's sort of the terminology that you've used. Now, obviously, you've adapted, as you said, well, because you're coming off of a really strong year. You're 22% net of fees, which I think followed one of the best years that Greenlight has ever had. So you've made the move, but you've also suggested to me that because you think the markets are fundamentally broken, that means fewer companies are going public, right? That's one of the ideas that you have. This change has reverberated through the whole market structure.
Yes, absolutely. When I say that the market is broken, what I'm saying is there's not enough money that is being dedicated to investing, trying to identify undervalued companies and reward companies with new capital that have good opportunities for growth, and to punish companies that don't have such good situations, because the professional industry of figuring this stuff out has largely been eradicated. And so the main problem that comes from that is you just wind up where index funds or other strategies, they're going to buy whatever's the most overvalued thing because they get the biggest weight in the index. So new money comes and overvaluation becomes more overvalued, undervalued becomes even more undervalued, and values actually diverge from fair value rather than come to fair value. But there's other ramifications of that. Once you have the largest shareholder in every major important company be a passive fund, shareholder activism becomes nearly impossible to improve corporate governance. Because if you go to one of these index funds and you say, I have an idea for how this company could improve that will make the stock price go up, they just kind of look at you and go, well, we want all the stock prices to go up. They don't and they don't have anybody on those proxy departments that even know how to value a company, let alone vote index shares in that kind of way. Another thing that's come, obviously, is the IPO market. The S&P is making highs. Right? We're in a favorable economic environment, and yet where's the IPO market? Why aren't companies able to come public? And the reason is companies used to do these things called roadshows. And they would come to these managers, these long-only managers, and they would say, hi, I'm the mid-cap manager of the such-and-such fund. Would you like to buy my new stock? And if that person isn't there or they don't have any new money, there's no one to buy that stock. And so you have a closed IPO market, even in the face of really, really favorable market conditions otherwise.
I want to talk about some other positions that you have within the market, because one of them, frankly, surprised me when I read one of your letters, which suggested that you, quote, stayed committed to the turbulent regional banking industry, and you bought more New York Community Bank in the fourth quarter. So I guess I sat back and said, wait a minute, Einhorn's supposed to be the guy who's saying, no, the regional banks are the ones with all the problems because of commercial real estate, but then you buy New York Community Bank. Why?
Right. Our theory was when they did the acquisition of the failed banks that happened roughly last March, we bought all of the regional banks that were the purchasers of the failed banks because we thought that they would get really good discounts. And we did it several times, and all of them except New York Community Bank worked. But when New York Community Bank came out with their result and took their charge, we immediately just sold all of the stock, and we exited at actually a very small loss.
Oh, you did? Okay, yes. So you're gone from those stocks. In terms of the market overall, you've spoken before about bubble baskets of names and names that have gone, parabolic because of various trends that happen to be going on at that particular time. Now, obviously, the focus is on AI. You made jokes about AI during your presentation today. Steve Cohen was on our network today, said this is not like 1999, that there's no bubble in the market. AI is durable. That's the word he used, and would lead to greater productivity and efficiency. Do you agree with that? Do you think we're in a bubble? What's your view?
No, I don't particularly think we're in a bubble. We covered our bubble basket stocks in the first quarter of last year. And right now, all of our shorts are idiosyncratic ideas based on situations with the particular companies that are involved. We don't have any basket short positions.